What is going on, YouTube Nation? This is Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So I'm going to be a little quick with this video, and I'm going to start Series 2 with my REITs next week, hopefully Monday or Tuesday. So make sure you hit that notification bell after you subscribe, and thank you so much. We're at 11,200 subscribers. A lot of people are asking me why I'm buying MPW. I'm going to explain to you why. I really like these guys. This is a real estate investment trust with a lot of controversy right now, but I'm going to explain to you why I'm buying these guys. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Smash that like button. And let's check this readout right now. So MPW is sitting at 1237 right now. A dividend yield of 9.35%. Average volume 13.85 million. Market cap is $7.43 billion US dollars. Year range is 990 to 2413. Its day range is 1198 to 1242, and its previous close is $12. So I'm going to explain to you why I like these guys. So one, going on their website, they're in 10 countries. They have 434 properties. Going over their portfolio, they have general acute care hospitals, behavioral health facilities. Mental health is huge right now. Inpatient rehabilitation hospitals, long-term acute care hospitals, freestanding ER, urgent care facilities, and other. So that's a lot of properties, 434 properties. So in their general acute care hospitals, these are for surgery, acute medical conditions or injuries, usually short-term stays. There's also long-term acute care hospitals for care that requires an extended day. Freestanding ER, there's a lot of people that need to go to the freestanding ER urgent care. Inpatient rehabilitation hospitals, and again, behavioral health facilities. They have 61. And I'm going to tell you, it is so hard with mental health now to get people into facilities because they're way at capacity, and there's a lot of problems with, the rise in behavioral health. I mean, people are not taking care of themselves. Self-care has been an issue. And I can tell you that it is just not good. Sedentary lifestyle has gotten worse. There's a rise in obesity. There's a rise in diabetes. There's a rise in hypertension. With these strong correlations, this is what's going on. People are going to need this. When people get amputations, when people get, when they get heart attacks, when they need cardiopulmonary rehab, when they need skilled rehab, this is what happens. These guys are in high-end demand. Again, this is not financial advice for entertainment purposes only. Disclaimer in the description. Also, let's check a few other things. And these are some beautiful facilities. This is in Germany. This is in the United States, St. Elizabeth's Medical Center. There's Ross Hall Hospital in the United Kingdom. So the diversification is very high. Knox Private Hospital, Southern California Hospital at Culver City. A Memorial Medical Center. And here's one in Switzerland. They also have other properties in, here's just examples, in Germany, United States, United Kingdom, Hanover, Germany. They have some in Portugal. So I like the diversification, and I like the size of these guys, which make them high in demand and a pretty solid dividend stock for their price. I'm also going to go over their revenue and dividend history real quick. So here's the revenue. This is in millions US dollars. 2015 it was 441, 2016 541, 2017 704, 2018 784, 2019 854, 2020 1,249, and 2021 it was 1,544. I'll even go further. Here's an article that came out August 3rd, 2022. Obviously this is in the past, but this is still what makes me feel good about these guys. Medical Properties came out with quarterly funds from operations, FFO 46 per share, beating Zach's consensus estimate of 45 per share. This compares to the FFO of 43 per share a year ago. These figures are adjusted non-recurring items. The quarterly report represents FFO surprise of 2.22%. A quarter ago, it was expected that the Healthcare Real Estate Investment Trust would post FFO 47 per share when it actually produced FFO 47, delivering no surprise. Over the last 4 quarters, the company has surpassed the consensus FFO estimates 2 times. So Medical Properties, which belongs to the Zacks REIT and Equity Trust other industry, posted revenues of $400.23 million for the first quarter, the end of June 2022, surpassing the estimate by 0.907%. This compares year-ago revenue of $381.79. Company has topped consensus revenue estimates 3 times over the last 4 quarters. Now, this makes sense from the previous years with all these issues because people didn't want to go to the rehab facilities because of the fear of COVID. I saw this as a nurse. And again, I'm not giving anything medical. I'm just telling you what I've seen with these guys and what was going on in the hospital. People were scared to come in the hospital in the beginning. The hospitals are actually empty in the start of the pandemic because people were afraid to come in the hospital. And that was a very stressful time because people were actually dying because they would refuse to go to dialysis. They would refuse to come in with chest pain when they had active heart attacks. There were a lot of people that dropped like flies because of the fear of the bug. I'm being straightforward with you. I'm being honest. This is what I saw, and this is what I experienced with patients. And unfortunately, I did take care of patients that did die because they did not want to go in the hospital when they could have been saved days before that, like with a cardiac cath or something. So this is what I saw that's going on, and it makes sense why they dropped in revenue. And I'm telling you, people are starting to go to rehab facilities again. So there's a high recommendation from physical and occupational therapy because of the sedentary lifestyle. Now I'm going to jump to their dividend history. And again, I hate to be graphic about what I said before, but that's what I saw. And that's what a lot of my friends have told me as well, because people were scared to go to places. And also, unfortunately, with COVID, there's a lot of nursing home patients that passed away. And, you know, people were afraid to go to skilled rehab and stuff. So that's why we would test patients before they would get sent to skilled rehab. And guess what? There were a lot of surprises in the late 2020 because you think that somebody's fine, and then all of a sudden they pop positive after a nasal swab, and that delayed their discharge to actually go to a facility because you don't want to send those people sometimes. So 2013, here's our dividend history: 20 cents, 2014, 21 cents, 2015, 22 cents, 2016, 23 cents, 2017, 24 cents, 2018, 25 cents, 2019, 26 cents, 2020, 27 cents. And then they cracked 28 cents in 2021. Then they cracked 29 cents. So the dividend growth in 5 years is not too bad. It's 3.88%. Payout ratio, according to Zacks, is 63%. The number of dividend increases the last 5 years is 5. So if you bought one share, you made 116 with a 9.67% dividend yield. If you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. I'm going to try to squeeze a video in Monday or Tuesday, so make sure you hit that notification bell after you subscribe. And again, I apologize about being graphic. I'm just providing my rationales as to why I buy and am buying MPW. I am not a pumper. I do not pump stocks. Again, this is not financial advice for entertainment purposes only. Disclaimer in the description. You guys take care and have a great weekend.